Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. Really two big pieces of news out of the marketplace today. First is overnight we reached conclusion on the debt ceiling deal, the Senate basically passing it, sending to Biden to sign. S&P 500 right now, right about 4250 as a level, which is nice. We've seen a little bit of a rally in the past couple days as it seems like that debt deal was coming together. And, we're happy to see, that actually got together and passed, and it doesn't look like we'll have to talk about that for at least another couple of years, which is great. The other major piece of news out this morning is the jobs report. We got U.S. non-farm payrolls at about 8:30 a.m. Eastern this morning. And I will say that is a monster jobs report. We added about 339,000 jobs for the month of May versus economists' expectations for about 190,000 job ads. That puts it in 14 straight months of gains in the job market or job market gains that have exceeded Wall Street expectations. So we're adding more jobs than Wall Street thought for about a year now. And it's really, we've had positive jobs growth ever since the COVID recession, which is actually not that surprising. But I think more importantly, that is the strongest month for job gains since January. So all of that kind of puts a little bit of a damper on this notion of, the Fed raising interest rates and the regional banking crisis and everything else like that, sending the economy into a tailspin. Certainly from a job creation standpoint, it doesn't appear like the economy was in tough shape. In fact, it appears like it was in great shape during the month of May. The flip side to that is we actually didn't see a massive increase in hourly earnings. So hourly earnings up 0.3% month over month, right in line with expectations. And the unemployment rate went from about 3.4% up to about 3.7%. Sometimes people forget how that's calculated. The unemployment rate is the total number of people that are looking for jobs over the total number of employed people. So if you get more people coming out of pseudo-retirement or looking for a job for the first time, or maybe coming out of temporary retirement, you can see, which we call the labor force participation rate, right? The more people that are actually actively seeking work, the higher that labor force participation rate is, the higher the pool of available workers is. So the good news, or the moderating news in May is that we saw more people coming out looking for jobs, which actually pushed the unemployment rate up. This is very much a double-edged sword. We don't want the economy. You guys, if you've listened to me before, know that, we're on this kind of teeter-totter here for 2023. We don't want the economy to be too weak because that's a recession and nobody likes that. But we also don't want the economy to be too strong, because that means that the Fed probably isn't done raising interest rates. At least for this morning, it seems like Wall Street's in the camp that Fed will not need to raise interest rates further based on this jobs report, largely because of the tick up in the unemployment rate. It's good to see, and sort of moderation in hourly earnings. Both of those things are good, even though the labor's market's strong. So kind of a Goldilocks moment jobs report for the market, which is, the market is currently receiving with great news. We will have to see how the Fed reacts to it. We got a couple of weeks before the next meeting, and so we'll have some time for some Fed speak between now and then to kind of get a little bit of guidance on, are we pausing here? Could we see another quarter basis point or not? But for the time being, everything looks kind of right down the center of the fairway. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.